Welcome, friends. In this edition on the live virtual classes for the paper financial advanced financial management batch 2, ICA Ashish Gupta Board of Studies, Faculty Board of Studies, Joint Director Board of Studies, and our expert CA Devas Gupta welcomes you all. Now, student, in this edition, basically the modus operandi is that you have gone through the lectures, recorded lectures that has been taken place in the month of January. There are three lectures for the same topic, advanced capital budgeting decisions. Now here in today's, Divas sir will revise you will all these three sessions, and you can take ask your query from the chat box, and even for the whatever the mode, there are two modes are available with you. And in the last 30 minutes, the floor will be open for you. You can verbally ask your queries. So, students, my request to you, please, whatever you have learned or whatever you carry, you discuss in this class, because these class will be very fruitful for you for your forthcoming examination in November 2024. Okay, sir, Devas sir, now it's your, you
Sure,
please
sir.
start the session. Thank you.
Sure, sir. Thanks a lot, sir, for the opening remarks. Good morning, all of you. Today we will start our discussion or our revision on the topic of advanced capital budgeting. So, students, in advanced capital budgeting, let me first take you through what all things we will cover today. Then we will go into the detail and do also take some revision on the questions aspects as well. So, in advanced capital budgeting, we started our topic with some of the recent changes or with some of the recent current trends in the capital budgeting, right? In that, we studied about inflation. There was also mention about changes in technology as far as the recent trends in capital budgeting is concerned. And lastly, changes in the government policies. So these three factors or these three are the current trends in the capital budgeting. We will go into detail. Then we also studied about how to tackle the risk aspect in the capital budgeting decisions. So we studied about different techniques, right? So if I broadly categorize all these techniques, there are three broad categories. The first one is statistical techniques. Okay, let me first say techniques of risk analysis. So the first block of the techniques in risk analysis was the statistical techniques. So this deals about the statistics in the entire data that we have, and hence it makes use of probability, then it also makes use of variance or standard deviation, then lastly it also had coefficient of variation. So don't you think all these three techniques are related to some or the other form of the statistics, and hence we have categorized these into the statistical techniques? We will cover in detail. Again, I'm saying I'm just plotting what all things we will cover today. We will discuss these things in detail after this introductory part. Then the second block of techniques for risk analysis was conventional techniques. What are these conventional techniques? So conventional techniques had two subparts. One was risk adjusted discount rate. Very important and very interesting topics in conventional techniques. Risk adjusted discount rate, and second was coefficient of certainty equivalent. Yes, good morning, Prashant. Good morning, Kameshwari, which we also called as certainty equivalent approach. Okay, these were the conventional techniques. Then the third block in techniques of risk analysis that we studied was other techniques. What were they? Sensitivity analysis, then scenario analysis, then simulation analysis, which had Monte Carlo simulation analysis, and lastly was decision tree. So if you have two options at every decision, we made use of decision tree. Okay. So these were the techniques, statistical, conventional, and other, and their sub techniques that we will cover again in today's session from a revisionary aspect. Then lastly, we also studied about the, okay, so let's say this is the first part of the discussion. This was the second part of discussion. And lastly, third part of discussion was the replacement decisions. Correct, students. So in advanced capital budgeting, apart from the risk, which we are able to manage in the second step that we have studied all these techniques, we have to also take into consideration when to replace a machinery, right? So that part was handled in the replacement decision discussion. Okay. Now let us start, students. We will start step by step, first of all, with the current trends. So this is the current trends. Current trends. Okay. So we'll start with the current trends first, and in that we will pick up the inflation. Now I'm heading back to my previous notes that all of you would have gone through in the sessions that were there earlier. So first part was inflation, students. Now, whenever we talk about inflation, there are always two terms that goes hand in hand. One is nominal and one is real. We tried to explain these terms. Nominal can be relevant for both. It can be relevant for interest rates. Can we say that nominal interest rate? Or it can be for cash flows also. We can say nominal cash flows. Now, what does nominal mean? Nominal is actually something that includes inflation element in that. For example, today, if you take any product and in the market, the price is, let's say, X. So today's price will account for the inflation that has gone into it, right? And you compare that price with 1 year before price. So there is a general trend increase that has happened, correct? All of us know because of the inflation, the prices has gone up. So those are called as the nominal prices, correct? Nominal prices is something that includes inflation. Now, from statistical perspective or from analysis perspective, we also need to know that what are those amounts excluding inflation. And hence those are called as real interest rates or real cash flows. Because they exclude inflation and hence they are called as the real cash flows. Correct? And as it was discussed that interest is always paid for two reasons. One is the time value of money, which is inflation. And second one is the risk. Risk of what? Risk of non-payment. Why will someone expect the interest? Because one, I'm losing the value of my money over a period of time. 1,000 rupees today will not be 1,000 rupees 1 year from now. It will have a lesser value. So I will charge interest for covering up my time value of money, which is also called as inflation. And second reason is I will also undertake risk. Risk that if I'm lending you some money, I will not be able to get it back, or I will be getting it on a delayed account. So risk of non-payment or risk of delayed payments, right? So all these factors leads to the charging of interest. I hope we are clear, students. And hence, and hence, the difference between nominal and real will give us the inflation part of the interest. I hope this is clear, because in nominal, inflation is included, and in real, inflation is not included. Okay. Now, there are two ways to calculate inflation. One is the direct subtraction, right, from nominal interest and real interest. So that it will give us the inflation. The second way is, which is more prevalent, is to take a division. So in a way, we are saying that inflation multiplies into the real amounts to arrive at the nominal amounts. So this was the formula that we discussed: 1 plus nominal rate divided by 1 plus real rate minus 1. Or we can rewrite it as 1 plus real rate into 1 plus inflation is equal to 1 plus nominal rate. And while rate we're talking about the interest rates here, students. Okay. So 1 plus real rate, which is the interest rate, if we multiply it with 1 plus inflation, we will arrive at the 1 plus nominal. So in these three, real rate, inflation, and nominal, if one of them are given, we can find out the other two. Okay. We studied one example also, 10 and 8. Now 10 minus 8 is 1, which is 2%. Or using by this formula, we will arrive at this inflation, which is 1.8518. Okay. Both ways are okay to solve it. Generally, we use the second way. Okay. That was also told in the previous session, that generally this second way of calculating the inflation is used. Okay. Perfect. So this was it on the inflation part. There was a question on the NPV part. So question, students, we will cover up after we cover all the concepts. Okay. So I'm leaving these questions as of now. Now let's come to the second part. After inflation, what was the second trend? What was the second current trend in the capital budgeting? Changes in technology, students. Okay. Now, sometimes there are, or not sometimes, but most of the times there are changes in technologies. There are upgradations in the technology that keeps on happening. That will compel the manufacturers to take a decision whether they want to upgrade, whether they want to adapt the new technology with the higher cost and with the associated lower, you know, or let's say with the associated savings. So in this, we took an example wherein we said that there is a manufacturer who is manufacturing the packaged drinking water. Now, for manufacturing this, the manufacturer needs three basic things. One is the bottle, one is the cap, and third one is the water itself. Correct? And they have done some capex on the machinery. Basis this, they will arrive at the bottled water. So bottle is going into the machinery, cap is going, and water is also going. Now what happens? There is a change in technology. Now this machine, the manufacturer of this machine has been able to even manufacture bottle also in the same line. So there is a raw material of preform that goes into the line that is blown into the bottle and then hence in the filling machine. Correct. So these are the changes in technology Because of the current changes in the technology, it is leading to the current trends in the capital budgeting. And hence, this might impact the capital budgeting decisions. Whether you are buying a bottle from outside or whether you want to do that additional capex and take a decision to expand your manufacturing line. Okay. Then changes in government policy, student. This was the third part on the current trends in capital budgeting. Now, government policies, if you see, student, they are broadly categorized into two parts. One is the fiscal policy and second one is the monetary policy. Now, fiscal policy is something that comes or that has a framework within it on the tax aspect, on the spends aspect of the government. Tax is what the income is from the government, and spends is what they are doing the expenditure for the benefit of the society. And hence, the entire fiscal policy is governed by budget because budget talks about the taxes and it also talks about the expenditure where the government is planning to spend. Correct? So fiscal policy has all the things to do with taxes and spends. And in spends, can we also include the incentives or the subsidies that government gives us? Yes. Correct. Because while you are planning for a big plant in any of the location, generally there are a lot of schemes under which you get the benefit of those incentives. Correct. So I will connect this point to the capital budgeting later on. But fiscal policies are clear, right? Then similarly, monetary policies. Monetary policies deals with the demand and supply of the money in the economy, right? So how much availability of currency bank or let's say RBI or let's say government wants to have in the economy? What is the cost of the currency? So all these things are taken into account in the monetary policy. All of us know RBI releases the monetary policy based revised rates, right? Repo rate, reverse repo rate, all those things are given by government, hence RBI. Now, what are the impacts of these two policies, fiscal and monetary, on the capital budgeting? While we talk about domestic capital budgeting, right? So in domestic capital budgeting, fiscal policy will have an impact on what is my tax outgo while I'm putting up a plant or what is the incentive I am getting. Correct? Similarly, on monetary policy front, what is the borrowing rate? Correct? Or what is my cost of capital? That will really determine my discounting rate. Correct? Now, if I talk about international capital budgeting, the fiscal policies will also include double taxation avoidance agreement, correct? In which the government enters into the bilateral agreements wherein they give benefits to either parts of the countries, right? Either to the this part or to the other part. Basis that the decision to invest in a capital budgeting can come, correct? Similarly, on the monetary policy, since bank rates will govern the demand and supply of the currency, and hence it will also impact the foreign exchange rate. Since the foreign exchange rate is getting impacted, our future cash flows might also get impacted. That will lead to the capital budgeting implications. Okay. And hence, these changes in the government policies have a very close interaction, have a very close implication on the capital budgeting decisions. And hence we have studied about inflation, changes in technologies, and changes in the government policies as the current trends in the capital budgeting, students. I hope this is clear. Okay, now let's go to the second part, which was the risk. First of all, we understand what is risk, and then we will also go through what are the techniques of dealing with the risk. Correct? The above pointers that we noted. Now, students, what is risk, first of all? The risk is that whatever you have thought in future, something will happen, something else happens. That is the risk. Correct? Now, you thought, let's say, while you toss a coin, head will come. But the risk is that tail can also come. Correct. So that is the risk. So if I define risk, risk is the deviation of possible outcomes from the expected outcome, okay, or from its mean. So that is the risk, how long, or let's say how we can deviate from the expected outcome. Now, while understanding the risk, we try to understand about three different situations. One is the certain situation, second one is the risk situation, and third one is the uncertain situation. So in certain situation, we said that there are certain things that are bound to happen. Why? Because there is an agreement in place. There is a binding agreement in place. So you know that in the future, cash flows are going to be this much only because I have a valid binding agreement in place. So can I say that there is a risk? No, there is a certainty because those cash flows are certain to occur. Correct? Now then let's understand what is uncertain. Uncertain is something which is something we are not able to predict. We because there are no historical trends or we don't have any experience. For example, if we have launched a new product, then we will not be able to make different scenarios that how much my revenue will be because we don't have a historical trend or we don't have any experience that how much sales will occur and hence how much will be my cash flows. Correct? Because my cash flows are dependent on the sales. I hope this is clear. So this is a very much uncertain situation. And in between these two situations lies risk. So students, risk is something wherein you can estimate different possibilities and assign some of the probabilities. Now, let's say we have in this example, we have a 20% probability to get a cash flow of 2000. This is possibility one. There is another 30% probability that we might get a cash flow of 3000. Okay. And there is another 40% probability that we might get a cash flow of 5000. If let's say, okay, now just see how the estimation process is working here. The estimation process here is saying that there can be some of the situations where we are able to achieve a very optimistic cash flow of 5000 rupees. Why? Because let's say the demand becomes huge of our product or whatever we are doing, right? So there are 40% chances. Then similarly, 10% chances of 1000 rupees. So there is a slightly lower amount possible also. So there is a risk, correct? Because we don't know something is certain, but at the same time, we also are sure that nothing is uncertain. So hence there is a risk. Risk we have divided into different four possibilities with the respective cash flows and their probabilities. And of course, we know that whenever we talk about probability, it has to always tie up to 100% or 1 because then only all the different possibilities will become feasible. Correct. Now, since we talk about probabilities and different possibilities, there has to be a best possible outcome. Now, if I talk about, in this case, there are only four possibilities, but in lot of other places, there might be thousands or lakhs of possibilities, right? So how do you analyze them? For analyzing them, we rely on two things. One is average or called as best possible outcome or called as mean. Correct? Mean is the best possible outcome or we also call it as average. In this case, we multiply the outcome with the respective probability and take a summation of it. Okay? This is called as best possible outcome, students. Okay? Because this is the average. Now, if I do this, it comes as 3400. But this analysis as of now is also incomplete. Why? Because we are saying that there is only one best possible outcome of 3400. There are no other situations possible. However, given the variability in the different possibilities, 2000, 3000, 5000, and 1000, we also need to define a range. 3400 can also go up and 3400 can also come down. That is called as risk. Correct? Now, we arrived at, let's say, risk is plus minus 500. It can go up by 500, it can go down by 500. So we think that 2900 to 3900 is the best possible range, students. It is the best possible range. And hence, our decision making is complete in this scenario where we also take into account the risk part. Okay, because in practical life, you cannot just simply say that, okay, my best possible outcome is 3400. I will go ahead with this. That's not the case. Okay, we always work with ranges because tomorrow this 3400 can go up or down. But to which extent? This risk extent. Now, one question will be coming to all of your mind is, how is this risk calculated? Correct? Although we understand the usability, or let's say the importance of this risk in the entire scheme of things, but what is this risk? How is this calculated? So students, we studied in the statistical techniques about probability. Second one was the variance or standard deviation. And third one was the coefficient of variance or coefficient of variation. So average cash flow or best possible cash flow or expected cash flow, all of them are called as mean in the statistical language. And risk is called as the standard deviation. So whenever we talk about risk, it is standard deviation or variance. Variance is also a square of standard deviation, or standard deviation is a square root of variance. So both of them are used interchangeably, and hence risk is actually denoted by standard deviation or variance. Okay. Then, as we discussed, the now what is the definition of risk? Definition of risk is deviation, correct, of possible outcomes from best possible outcome, correct? Since we tried to define that plus minus 500, that takes into account what is the deviation possible, what is the deviation of the possible outcomes. And hence the formula will also look like the same. We will discuss the formula. Okay, now let's come to the technique. Probability we discussed, this is a chance of an event occurring, right? It is always forward looking, students, correct? We always try to calculate the probability of what is going to happen in future. And it always ranges from 0 to 1, or I can say 0 to 100% if we talk about percent. 0% to 100%. Okay, it's one and the same thing. Then forward looking data, when we talk about forward looking data, it can be, the calculation will be in two forms: expected net cash flow and expected net present value. I hope you understand the difference between net cash flow and net present value. Net present value has an element of discounting involved. Okay. Although net cash flow is just simple multiplication with the probability, students. Okay. Then there were these questions. Question number 3, question number 4. I'm skipping the question as of now. Yes, let's come to the variance or standard deviation, students. This we called as risk. Correct? So as we studied that deviation of possible outcome from the expected outcome, that we call as mean. Now, this is denoted by this sign. Okay, this is the sign for standard deviation. And the square of this becomes the variance. What happens if you open a square, or let's say when you do a square root? Okay, this is, let's say, variance, and you do a square root to arrive at the standard deviation. Correct? That's how you will do. The moment you do, you always add plus minus. That is the reason the range that we defined above for risk plus minus 500, yes, you remember all of you? That is because of this reason. Okay, because it can go plus also, it can go minus also. Now, let's expand the formula of variance. Let's try to understand the formula of variance. So, expected net cash flow, this is the mean best possible outcome. And we are taking a deviation of every possible outcome from this mean and multiplying it with the respective probability, students. Clear? So we are actually calculating the deviation of the possible outcomes from its mean. Okay, that's what the definition is. And the formula wise is for every possible outcome, we have to do this subtraction and then we have to multiply it with the probability and take a summation of all of them to arrive at variance. Now from variance, we can arrive at standard deviation by taking a square root of the same. Now, let's try to analyze the impact of variance. So if variance is higher, that means risk is also higher. That means there is a good amount of, let's say, the range is quite big, correct? Because higher variance means the plus minus will also be higher in the expected outcome, correct? Lower variance means the range of the future cash flows, or let's say of the different possibilities, is small and hence there is a lower risk. Lower risk of what? Lower risk of our actual outcome will be very much similar to the best expected outcome because the risk is lower. Okay. This is clear. Higher variance, or I can say higher even standard deviation also here. Similarly, lower variance, lower standard deviation is equal to lower risk. As I said that variance and standard deviation can be used interchangeably. Now, students, this example was very much important to understand the coefficient of variation. Project A and project B, we have put down two projects with their risk and expected outcome. That means standard deviation and mean in statistical terms. So standard deviation was plus minus 100 for project A, and project B it was slightly higher, plus minus 120. Mean was 500 here, and here in project B, the mean shot up to 1200. Now, if we want to compare this, what we should compare first, whether risk we should compare first or mean we should compare first, or there is some third element that we should take into account. So students, herein we discussed the third element, which is the coefficient of variation. We said that for 1 unit of mean, how much risk we have to undertake. Correct? If we take coefficient of variation, it takes into account both the things, risk as well as mean. Because what we do here, we take risk divided by mean. So 100 divided by 500, which is 0.20. 120 divided by 1200, which is 0.10. Now, what does this imply? For 1 unit of mean, project A will have a risk of 0.20. For 1 unit of mean, project B will have a risk of 0.10. So do you think that in project B, the risk is lesser? For same unit of mean, the risk is lesser, correct? So that means project B is better. This is a better project compared to project A. Because for the same level of mean, we are getting a lower risk. So students, there are two ways to see it. Either the risk should be lower in the project for the same level of mean, or for the same level of risk, mean should be higher, or let's say the expected outcome should be higher. Okay. Let me know, students, till here if there is any other doubt, because we have covered the statistical techniques, all the three parts: probability, standard deviation or variation, and lastly, coefficient of variation. These three parts have been covered till now, students. If you have any other queries, please do let us know. Then we will move to the next part. Okay, perfect. So let's move ahead, students. Then let's come to the conventional techniques. In conventional techniques, the first one was risk adjusted, discount rate, students. So as the name suggests, the discount rate is adjusted for risk. Simple. If discount rate is adjusted for risk, it will become the risk adjusted discount rate. As we studied, interest is paid for two reasons. One is the time value of money, which is inflation, and second one is the risk of non-payment and risk of delayed payment. Now, first of all, students, the discount rate is actually a combination of risk-free rate and risk premium. So let me tell you, discount rate is definitely including risk-free rate. There is no doubt about it. Correct? I think all of you will agree with me. However, it also includes risk premium to the extent the risk is part and parcel of the capital budgeting project that we are evaluating. For example, the project that we are evaluating has a risk premium of any percent, let's say 8%, 4%, that will get added to the discount rate while we are discounting it. And how do we arrive at this 8% or 4%? That is with the help of beta, or with the help of other, or let's say with the help of other factors, right? So in scenario one, for example, we said that risk-free rate is 7%, and basis our calculation, we come to know that the risk premium is 8%. So the discount rate at which we will discount the cash flows will be 15%. In scenario two, we said that risk-free rate is 7%. It will remain same, right? Risk-free rate remains same between both the scenarios at a given point of time. The risk premium is 4%. Why risk premium is lower in scenario two? Because the project is less risky. The cash flows are less risky, and hence almost half risk premium we have taken here. That becomes 11%. So 11% we will use as a discount rate to discount the cash flows. Now tell me, students, if you discount basis 15%, or if you discount basis 11%, where will you get the higher NPV? Tell me, students. Can you type in the question handle? My question is whether you discount by 15% or 11%, which is, let's say, option number one or option number two, where will you get the higher NPV, higher net present value? Is it in option number one or option number two? Abrakesh has said two. Yes, students. All of you can participate in these questions so that it will be more interactive. Yes, Lakshmi is saying option 2. Perfect. Very good. So in option 2, we will get a higher NPV because lower discount rate will result into the higher net present.
Devas sir,
Yes, sir.
I think Prerna Sharma has also messaged on the chat. Just check
Oh,
it the same.
Uh, okay, sir. I am not able to see that.
You just see the chat option box in your.
Okay. Okay. Yes, Prerna Sharma. I got
Yeah.
your message now.
Uh,
11%.
so
Perfect.
the student can use the both mode.
Yes, sir. Perfect. So, Prerna Sharma, you are absolutely correct. Lakshmi, Prerna Sharma, and Abrikesh, thanks for answering. It's basis 11%, we will get the lower NPV. Now, don't you think wherein lower NPV, higher NPV of whatever that amount will be is coming basis the lower discount rate. That means lower discount rate will imply lower risk premium. Correct, students? And hence, lower risk premium means that the project is less risky. So now our chain is complete. Lower risk in the project will lead to higher NPV. Higher risk in the project will lead to lower NPV. So this is the analysis that we came to know. Okay. And which should be, because if the project is having a higher amount of risk, NPV should be lower. Correct? Because the variability in the cash flows will be higher. Okay, students? So this is the concept on risk adjusted discount rate. It simply says if your risk is higher in a project, take a higher discount rate. Okay. Then the second approach within the conventional technique, which was more or less related here, was the certainty equivalent approach. I think Prashant has also replied. You are absolutely correct, Prashant. Second option at 11%. Now, this certainty equivalent approach, students, has to be understood with these two situations. In situation one, we said that, and these two situations are for the same project. It's just different way of defining the cash flows. The first situation says that there is a 2 lakh rupees of cash flows, but we call them as a risky cash flow because this includes a risk element. Okay. Or there is another way of telling is, look, in this project, there is a guaranteed cash flow. There is a certain cash flow of 1,50,000. Okay. And balance 50K or 50,000 is actually related to some of the outcomes that will depend whether it will happen or not. And hence we are terming it as risk related cash flows. Okay. This is the second situation for the same project, for the same year also. Now, if we talk about coefficient of certainty equivalent, what does this mean? Certainty equivalent, it says that you take your guaranteed cash flows and divided it by the risky cash flow to arrive at one percentage, or let's say one coefficient. Coefficient means something that is, let's say, 0.75 here. Okay. What is the factor? So this says you that out of your total risky cash flows, 75% are guaranteed ones. 75% are certain ones. Hence, they are called as certainty equivalent. As I said here, 0.75 times of the risky cash flow is equal to the guaranteed cash flow, students. So 2 lakh can be divided into two parts, 1 lakh 50 and 50,000. And with this, can we arrive at one equation? Yes, certainty equivalent coefficient is equal to the guaranteed cash flow divided by the risky cash flow. So the guaranteed cash flow will become can be calculated as risky cash flow multiplied by the certainty equivalent, or any one variable is missing in these three, the other two can be used to calculate the third one. Okay. Now, very, very important point, students. Tell me one thing, basis our previous discussion in the sessions. If I'm using certainty equivalent approach, okay, if I'm using certainty equivalent approach, so will I use the RADR rate or risk-free rate? So in the cash flows, I have already multiplied the CE coefficient, okay, and made my cash flows as guaranteed cash flows. Now tell me whether I will discount these guaranteed cash flows using the RADR, which is the risk adjusted discount rate, or risk free rate. Tell me, students. Okay, Prerna is saying RADR. Okay, the question is, if I have already used the certainty equivalent approach to make my cash flows as guaranteed ones, now my cash flows are converted into the guaranteed cash flows. So will I use RADR rate or risk-free rate, students, while discounting the NPVs? Okay, Prerna is saying RADR, Abrikesh is saying RADR. Very good. Lakshmi is saying risk-free rate. Can we expect more answers? Prashant, Kameshwari, all of students who have logged in. Okay, so the correct answer here is, students, that if your cash flows are already guaranteed cash flows, there is no risk in the cash flows. So we will use the risk-free rate, students. Correct? We will use the risk-free rate. So this, we derived it using this discussion. RADR, what it happens, it increases the discount rate and it has an impact of reducing the NPV. Correct? That is understood. For certainty equivalent approach, it has the impact of reducing the cash flow and hence reducing the NPV. Yes, Lakshmi, you are correct. Lakshmi is saying if RADR is used, it's double counting of the risk. That is absolutely correct. So if we use RADR, we increase the discount rate and hence reduce NPV. CE, we reduce the cash flow and reduce the NPV. So what happens? I will come to this line later on. Then what happens in RADR? The cash flows has to be taken by including the risk part and the discount rate also to be including the risk part, which is the RADR rate. So whenever we want to use risk adjusted discount rate, we will always take the including risk cash flows. And while we talk about the certainty equivalent approach, the risk should be excluded. That is what certainty equivalent coefficient is doing. That will make the guaranteed cash flows. And hence we should use the risk-free discount rate, students. Okay. Now let's go through this part, what we mentioned. Now there are some advantages and disadvantages. For risk-adjusted discount rate, since the discounting is happening with the one rate for all the, let's say, 5 years, 10 years, or 15 years, whatever is the life of that project is, so the same risk premium is assumed for all the years. However, in CE approach, we can assume different risk premiums, or let's say different risk factors for the different years cash flows. Okay. Yes. So K. Prashant is saying risk is already adjusted, so risk-free rate shall be used. Yes. So if my cash flows are already guaranteed, I should use risk-free rate. Okay. I hope this is clear, students. Yes. So let's move ahead. Okay, perfect. Now, just a second. Let me just. Yes. Now, with this, students, we have completed two blocks of our techniques. One is this one is the conventional techniques, and first one was the statistical techniques. Now let's come to the other techniques. So from here we start our other techniques. Now in other techniques, students, the first one was sensitivity analysis. Now sensitivity analysis is very, very important because what is capital budgeting? First of all, capital budgeting is a model, correct? Model of calculations, right? We do calculations, we take a present value, we take cash inflows, cash outflows, take a present value, and finally the outcome is NPV. And there are certain inputs that goes into the model of the calculation, which are cash inflows, cash outflows, discount rate, time period, and other things, right? Even the factors that it used to calculate the cash inflow are also sometimes called as input. For example, the sales volume and other things. Now, all these inputs are having some assumptions, correct? I'm assuming my cash flow, my cash inflow for the next year will be 1,000 rupees. I'm assuming the cash inflow for next to next year will be 1,200 rupees. That is, it will grow by 20%. Correct? Those are all assumptions. Correct? Now, what if I change my assumption? What will be the impact on the NPV? And I have to be careful in sensitivity analysis, wherein if I'm changing assumption of one factor, I will have to keep the other factors constant. Then only I will get the impact because of the change in that one factor. So for example, students, I want to analyze the cash inflow related sensitivity. So I will change cash inflow by some amount. Let's say I will increase the cash inflow or I will decrease the cash inflow, whatever my situation is. And I will keep all these factors constant to arrive at the real impact on the NPV. Okay. Now, in this case, there will be a base case NPV. Okay. And second one will be the changed NPV. There are different names that we can say depending on the situation that is given in the question. So, base case NPV is taking cash inflow, whatever we have assumed. Changed NPV is whenever we change the cash inflow, what is the impact on NPV? So that will give us by changing cash inflow only what is the impact on NPV. And similarly, cash inflow, we can do this analysis on cash outflow also, discount rate, time period. On all these factors, we can do this analysis. This is called as sensitivity analysis, students, because we are trying to find out that which factor is leading to a bigger change in NPV. And the most sensitive factor is called to be that factor with the smallest change in the input. It can bring a very big change in the output, which is NPV. Okay. We have done sufficient questions also to support this concept. So sensitivity is clear. Now let's come to the scenario analysis, students. So scenario analysis is we have different scenarios. And in one scenario, there will be different set of values for cash inflow, cash outflow, and discount rate, for example. So this is the scenario one. And in scenario two, all these values will change. So the difference between scenario and sensitivity is sensitivity, we change one factor at a time. Scenario, we create different scenarios and hence they might have different values for the different scenarios, even more than one factor, correct? So that's how scenario analysis is. And in this, we calculate the NPVs under different scenarios. Okay. Now let's come to simulation. This is very, very important and very, very practical topic, students, because simulation is used today in a lot of things in practical life. So first of all, what do we mean by simulation? So by layman language, simulation means to simulate the entire process with a different set of values, correct? You can simulate anything. If you, what do you need to simulate? You just need these three things. You need some set of inputs. Okay. You need some set of inputs and you need to have one method, or let's say one calculation, or let's say one model or process, whatever you want to say. I'm, since we are studying the capital budgeting here, I'm calling it as a model. Model, what do we mean by model? Model is all the formulas that we prepare, right? We take a present value of the future cash flows, we calculate the terminal value, then we take the present value, we reduce it from the initial cash outflow to arrive at the output. So that entire process or entire model of calculation is this. And lastly, the output. Okay. Now, here what we will do in simulation is we will generate the output for infinite number of inputs. By infinite, I mean thousands, lakhs, crores. Okay, we will keep on checking that if we input this value, what will be output? Then second outcome is this input, what will be the output? Third possibility, or let's say the third scenario, this one, and hence this will be the output. Like this, we will keep on simulating multiple times. And this is handled by complex, models. So this will give us a very large number of outputs, which will be in, let's say, lakhs. I'm saying to restrict my discussion, I'm saying let's say we are doing it for the 1 lakh observations. Okay. So 1 lakh different inputs are going and 1 lakh different outputs are coming. Okay. To restrict the discussion, I'm taking 1 lakh. Now, first of all, this 1 lakh inputs are based on random numbers. Okay. Why random number? Because we want to exclude the biasness of the person who is running the simulation. Okay. Now, random number is something which is very random. If I tell you that, you have to give me 1 lakh inputs that I will put in the model, right? One way is that, your biasness will come. No, okay, I will say more than 90%, I will say less than 10%, I will say 50%, or whatever it is. But random number, why it is used is because it is free from biasness. Correct? The person who's running the simulation, his or her biasness will not come in the random number. Now, random number can be, let's say, today, now these models also will give you the random number. And these random numbers, it's not that today, let's say at 8 o'clock, whatever random number are getting generated, at 8:01, the other set of random number will get generated. Okay, it's like that fast. It will not make it constant. So there is no scientific way of arriving at, okay. And there is no logic behind it. It's just a random number. So one is random number. I will then connect how we will use it. Then the other two parts that are used in the simulation are parameters and exogenous variable, students. I think the names are only fancy, but it is very easy to understand. As I said that in the inputs, okay, I'm just writing it here. What are different level of inputs in capital budgeting? Broadly, these are four, right? Cash outflow, then discount rate. Just a second. Yes. I'm just taking these four examples: cash outflow, discount rate, cash inflow, and time period. These are the four input, students. I'm taking an example because we're talking about capital budgeting, and hence we have to restrict our discussion on these four inputs. Now, while in sensitivity analysis, we said that one factor to be changed at a time. In simulation, also, we have to focus on certain factors that are bound to change and certain factors that we want to keep them as fixed, right? Because if we keep on changing all the factors at a given point of time, it will lead to big amount of changes, and hence our analysis might go for a toss. So as a simulator, or let's say as a person who is analyzing this simulation, first of all, we need to be clear that certain factors I need to keep it fixed, which will not change during the changes in the inputs. So I'm fixing cash outflow and discount rate. I am fixing them. I will not change it through this entire 1 lakh different calculations. Okay. This cash inflow and time period is something that I want to change as an input for this 1 lakh different calculations. Okay. So this fixed variables are called as parameters. These are still called as inputs. And wherever these inputs are bound to change, these are called as exogenous variables. These exogenous variables will change for 1 lakh times to give us 1 lakh different outputs. I hope this is clear, students. Now let us connect the random number here. So random number will be used to arrive at the different exogenous variables. Let us see how. So students, let's see this. These are the random numbers: 10, 20, 35. Okay. It has been generated or someone has thought through it. We take these random numbers at the probabilities: 10%, 20%, 35%. Okay. We convert them into the probabilities. Using these probabilities, we arrive at what should be my cash inflow and time period. Okay. How do we do that? Because already the cash inflow and time period, we have the probability wise details, correct? If let's say 10% comes, then what will be my cash inflow? If 20% comes, what will be my cash inflow, and hence what will be my time period? So we will, based on these random numbers, we will take 1 lakh random numbers. Against that, we will have 1 lakh different cash inflows. And against that, we will have 1 lakh different time period. Okay. For those probabilities. And using those combination of 1 lakh cash inflow and 1 lakh time period, we will arrive at 1 lakh output. Clear? Now, what we will do with this 1 lakh output? All of you might be thinking it is not having any basis. Now, the point what I'm trying to say is that 1 lakh output then again will be viewed on a average basis, or let's say some other statistical basis, to say that now this is the correct value, or let's say this is the best possible value that can happen. So for this 1 lakh outputs, we will again take a mean or standard deviation or any other value, whatever is the, let's say sometimes median, sometimes mean, sometimes other statistical value, that depends on the analysis. For the benefit, I'm just saying it's mean, and hence it will give us the best possible value. Now the entire crux of this analysis is that whatever your input is, we have taken a large population of input, and hence we have arrived at the large population of output. So this large population of output covers almost all the scenarios that can come, and hence the average of those 1 lakh outputs will give you the best possible outcome as mean. So that will be called as the best possible outcome, which is in this entire process is called as the Monte Carlo simulation. Yes, Abrikesh is asking, does it happen in the practical or real life? Yes, it happens. Lot of places today, students, the valuation is dependent on the simulation. Specifically, this is used in valuing from the actuarial point of view and other areas as well, wherein lot of iterations are possible, the approach is used. Okay. I hope this approach is clear, students. We have actually in our other sessions, we have also covered one question that is given in the study material. So that will help us. That will help us in understanding the concept, students. Just a second, there is one more question. Yes, other parameters are assumed to be constant because some, see, in this example, we have taken only four parameters, right? But in practical life, there can be n number of parameters, Abrikesh, right? So what they do is some of the parameters they have to assume as constant, which they know are certain, which are bound to happen, correct? Hence, I have also assumed cash outflow, which is today, it is bound to happen as same, right? That we know that if I have to spend on a machinery, it will be fixed as of today. But what I don't know is the cash inflows in future. Okay. So it happens. So simulation is done, students. I hope this is clear. Now let's come to the decision tree analysis. This is the fourth technique for this is the fourth technique for the subgroup of other techniques for analyzing the risk analysis. Now decision tree is very simple, students. Decision tree is that first of all, you are taking some decision, whether you want to do it or whether you don't want to do it. Then if you decide you want to do it, it will break up into different possibilities. So wherever we have a square like this, it is called as a decision node where the person is taking a decision. And wherever there is a circle, it is called as a chance node. Chance node means there are different chances or there are different possibilities possible. And these are called as the different possible outcomes. Okay. Now, decision tree is very useful in those situations wherein we have chain decisions, right? Let's say if this happens, then I will take a further step. And if this does not happen, I will take another step. And similarly, after taking that another step, I have further decisions to be taken, right? So it's like a tree. It starts from one and it can get into different branches, students. And what will be the end outcome using the decision tree analysis? One, we have to first form a decision tree, and basis forming it, we have to calculate it backwards from this XYZ, what it will translate it here, and from here, what it will translate to A by multiplying it with the respective probabilities, students. Okay, we have already discussed in our previous sessions how to make the decision tree and how to come at the A part. Let's say in this question, again, we will come to the questions. First, let me see. Yeah, lastly, now the last part of the conceptual discussion is on the replacement decision, students. So replacement decision, students, is a very logical part, right? If you see, there is an existing capital machine that is operational, that is due for replacement or not due for replacement. There is a change in technology. There is a new machine that has come in. So how do we decide? So students, here we make use of the incremental cash flow technique. Okay. By incremental cash flow technique, what do we mean? So incremental cash flow, it can happen for both cash outflow and cash inflow. Cash outflow What is the incremental cash outflow? Whatever you are spending on your extra machine cost for upgradation or for buying a new machine, minus the salvage value of the existing machine. Because existing machine you will sell off in case you're planning to buy a new machine. And plus minus some of the tax adjustments that will come on the existing machine. Because the moment you sell your existing machine, there might be a tax implication on it. Okay. Similarly, for cash inflow students, the objective of putting up a new machine is because you will generate some savings compared to your existing machine. So we will only take the incremental revenue or let's say incremental cost savings. And similarly, the salvage value of the new machine because we will be selling it after the completion of the period. So we compare the incremental cash outflow with the incremental cash inflow to arrive at the decision whether we want to replace it or not. Okay. A very, very important part here is the calculation of the equalized annual cost. Okay, students, can you tell me, basis whatever sessions that were taken earlier, can you tell me why there is a need of EAC? Okay, let me go to the last page. So this is the last question from me on the conceptual building. Then we will cover some of the practical questions which have some catch, right? So can you tell me why there is a need of EAC? This is very, very important. Equalized annual cost. What do we meant by, or in what situations there is a use of EAC concept? Okay, Prerna is saying to determine the optimal replacement cycle. Good. So that is an outcome of using EAC. I am asking in what situations you will use EAC, students. When do you think that EAC needs to be used? Okay, let me explain. Let's say there are projects. Okay, Abrikesh is saying different cost during the year. Okay. Okay, let me just put it. We have three different possibilities. Year 1, year 2, and year 3. We have three different. Yes, very good. Lakshmi has given the right answer. Unequal lifespans. Perfect. So NPV, let's say I'm talking about three different cases. NPV for year 1, NPV for year 2, NPV for year 3. Not for year, but for year 1 project, NPV is this much. For a project that has 2 years life, NPV is this much. And for a project that has 3 years life, NPV is this much. There are three different NPVs given for the project having different lifespans. Now, do you think really this NPV is comparable? No, right? Because here the project life is only for 1 year. Here it is for 2 years and 3 years. That is where the concept of equalized annual cost is used. Okay. And hence it will help you in arriving your optimal replacement cycle, as Prerna said. Okay. That is the outcome once we use this part. So students, with this, we come to an end on the conceptual part. Now let us cover some of the questions also in our revisionary part. Okay. So this is all done. Replacement, other techniques, conventional, statistical, and current trends, students. Yes. So let me pick certain questions, students. I will not be going through again all the questions. In case you have any specific doubt in the specific question or you want me to repeat that question apart from what I am covering, please do let me know. Okay. So these were the some of the basic questions, students, that helped in the conceptual building, and hence I am just skipping them as of now. Question number 5. I'm just picking up certain questions which had a real catch. Yes. So question number 6, I'm taking an enterprise is investing 100 lakhs in a project. The risk-free rate. Now, students, we have to read the question very carefully. It is giving a risk-free rate of 7%, and the risk premium expected by the management is also 7%. Now, here they're talking about risk premium. Sometimes the question may call it as the risk-adjusted discount rate also already. In that case, premium is included. So just see what whether it has to be added or it has to be taken as is. The life of the project is 5 years. Following are the cash flows that are estimated over the life of the project. These are the years and these are the cash flows. And hence it is asking us to calculate the net present value of the project based on the risk-free rate and also based on the risk-adjusted discount rate. Now, why I've picked this question is that some of you might think that as a thumb rule, what we have decided, if cash flows are risky cash flows, we will always use RADR, correct? Which is this case. However, the question is specifically asking us to take the risky cash flows and use the discounting basis the risk-free rate. So we will do that as well. Okay. Because let's say the management might want to know that what is the difference between these two values on account of the risk premium. Correct. So that is the logic. So first we will take the 7% and do the discounting of these cash flows. And second one, we will take the 14% as the risk adjusted discount rate, students, to arrive at the cash flows. And we will reduce the cash outflow also to arrive at the same. So see, here we have given the conclusion also. So this is the NPV basis 7%. It comes as 144.34. Basis 14%. It comes as 99.79. Now, if the management may want to ask you that what is the impact on NPV because of the risk, can we tell that? Yes, 144.34 minus 99.79. So it becomes 44.55 crore will get impacted just because we have taken a risk premium of 5%, students. Okay, I'm just saying it's a different way of analyzing. Yes, Prerna, higher risk, lower NPV, which is the case here as well, 14% to 99.79%. This was relatively easier. We have got the certainty equivalent coefficient. Now, if you see, students, here in the question number 7, as I said that, what was the advantage and disadvantage? Advantage was in certainty equivalent coefficient, you can have different coefficient for different years, students. Correct? And that will help you to adjust the different risk elements in the different years also. Okay. This was the question on sensitivity scenario. This is again the scenario. Simulation, students, we have covered from that. Yes. So let's cover this question actually. This is very, very important. Important, I mean something perfect. I hope the question number 10 is visible now. L&R Limited wishes to develop new virus cleaner software, students. Okay. The cost of the pilot project would be 2,40,000. Presently, the chances of the product being successfully launched on a commercial scale are rated at 50%. So what we will do, first of all, we will do a pilot. If that pilot is successful, then 50% chances are that we will launch it in a commercially bigger scale. In case it does not succeed, L&R can invest a sum of 20 lakhs. Sorry, in case it does succeed. So they are further evaluating. In case it does succeeds, L&R can invest a sum of rupees 20 lakhs to market the product. Such an effort can generate perpetually and annual net after tax cash income of rupees 4 lakhs. Okay. So they are saying further, the decision to invest 20 lakhs is dependent whether at a first step it will be successful or not. You see, there are multiple things that are interrelated. Now they're giving us the second option. Even if the commercial launch fails, they can make an investment of a smaller amount of 12 lakhs with the hope of gaining perpetually a sum of rupees 1 lakh. Evaluate the proposal adopting decision tree approach. The discount rate is 10% students. So while we have to do the calculation part, but before that, we have to be clear that what is the decision tree looking like. So students, we are standing here, let's say on A. Now today we have two options. One, to do a pilot at the rate of 2,40,000. And the second is do nothing, correct? So do nothing, zero cash flow will get generated. Now if I do a pilot of 2,40,000, I have two different outcomes. So this is outcome number one, whether it will be a successful one, or outcome number two, it can go to a failure also. And both of them have 50-50% chances, because here it was mentioned 50%. And if goes successful, then also I have two options to do. I will come at C part now. Okay. So which is again a decision point. Here, either I can invest 20 lakhs to arrive at the 4 lakh per annum amount, or the second option is do nothing. Okay. Do nothing, I will have zero. No inflow, no outflow. I have just been successful. I will not do anything more. Now, in case of failure, which is the D decision node, or let's say decision point, I have another option to invest 12 lakhs per annum. So sorry, 12 lakhs now and get 1 lakh per annum, students. And the second part is do nothing. Okay, so this is the decision tree. I hope this is clear. Because my decision to invest 20 lakhs to generate 4 lakh per annum is actually dependent if my project is successful, and this successful project is dependent whether I will do this test run or not. You see, there are dependencies. So let's do the calculation part now. Now, students, whenever we do a calculation part, we always move from here to here. I mean, from the right to left, we go. Reason being, we first clear whatever the cash flows at the farthest node, and then we come to the A point. Okay. So let's start with the C point first. So at the point C, 20 lakhs investment will get us 4 lakhs perpetually, correct? That means the present value of cash inflows will become what, students? What is our discounting rate? 10%. So 4 lakh divided by 10%, that becomes 40 lakh, students. Since we are talking about the net present value, and hence we have to reduce the cash outflow of 20 lakhs to arrive at the net present value. So 20 lakhs becomes the expected amount at point C. Correct? Because At point C also, there are two options, right? One is to invest and one is to do nothing. So overall, if we invest, we have a benefit. So we should do the investment part, and hence C will witness a value of 20 lakhs to it. Now let's come to D. D, we have a perpetual saving of 1 lakh. If we convert into the present value of the cash flows, it becomes 10 lakhs. 12 lakh is my cash outflow. My NPV will become negative 2 lakhs at point D. Correct? So it is better for me not to invest in case I fail, right? In case I fail, it is better to do nothing. Because if I invest 12 lakhs to arrive at a cash inflow at 1 lakh per annum, I will make a loss of 2 lakhs here as NPV, right? So, so it is not recommended to invest. Perfect. Now let's come to node B, this one. Okay. Now node B, success and failure, there are two options, right? C and D, either C or D. Now success, we will get 20 lakhs, probability is 50%. Failure, we are saying we will have a zero cash flow because we will not invest 12 lakhs. So there's a 50% chance. So multiplying it, we will get 10 lakhs on node B. So the expected monetary value becomes 10 lakhs. Now, at decision point A, students, we understand that if we do a test pilot by investing 2,40,000, we can generate a return of 10 lakhs at node B, right? Or decision two is invest nothing with zero return. So what will you do? You will definitely invest 2,40,000 with a return of 10 lakhs. So decision one is preferred. So you see how step by step we first plotted our decision tree based on the different outcomes which are dependent on the previous outcomes. And from farthest, or let's say from the right towards the left, we move to get the decision right by step analyzing the decision, students. Okay. So this was a good question on decision tree and hence we've attempted it. Any queries till now, students? Till now, otherwise let's break for 10 minutes now. It's 8:28. We will again reconvene at 8:38, students. Thank you. Just a second. Yes. So after doing question number 10, let's scroll through. Sorry. Yes. So let's do this question number or discuss this question number 11. Perfect. So it says that a company named Ruby's Cube decided to replace the existing computer system of their organization. Original cost of the old system was 25,000 and it was installed 5 years ago. Current market value of the old system is 5,000. That means it will be sold at the current market value. Depreciation of the old system was charged with a life of 10 years with the estimated salvage value as nil. Okay. Depreciation of the new system will be charged over 5 years. So they are just trying to give us the fact pattern of both the old computer and the new computer. Estimated salvage value of the new system is rupees 1,000. The estimated cost savings with the new system is 5,000 per year. Increase in sales with the new system is assumed at 10% per year based on the original total sales of 10 lakhs. So there is a cost savings that will come with the new system, and there is an increase in sales on 10 lakh at the rate of 10% that will also come. And they've also mentioned that the company follows straight line method of depreciation. Cost of capital is 10%, whereas tax rate is 30%. So they have given us all the information that is needed to analyze whether it is okay to replace the system now or not. Okay. So we will just organize the information firstly in the existing and the new bucket. Existing original cost was 25,000. 5 years has been passed by. Current market value, if we sell it in the market, is around 5,000. Then useful life, original useful life was 10 years, and hence the depreciation would have been 25,000 minus nil, which is the salvage value, divided by 10. So that means 2,500 per year would have been the depreciation, and hence the WDV on the fifth year will be 25,000 minus 2,500 into 5 years that has lapsed. That means WDV becomes 12,500, students. Easy. On the date of decision. So there's a WDV on the date of decision. New computer has a useful life of 5 years, cost as 50,000 and salvage value as 1,000. And incremental cash inflows are 10% of sales and 5,000 per year on account of savings. Now, as I said that in all the replacement decisions, most of the replacement decisions, we have to work through the incremental cash flow method. And it had two parts, right? One is the cash outflow and second one is the cash inflow. So let's first calculate the net cash outflow on an incremental basis. So the cost of the new system, which is the extra machine cost, remember in the part, this is 50,000 that we will take straight away. The salvage value of old system, it will be a cash inflow. This will be a cash outflow. Okay, because I will sell and I will realize 5,000 now. The moment I sell it, there will be a tax related gain or loss on the old system. How it will be computed? My selling price is 5,000 and the WDV that we have computed is 12,500 above. Correct? So there is a loss on sale because the value in my books was 12,500. I'm selling it as 5,000. So there is a loss on sale of 7,500. On this loss, I will get a tax savings. Correct? Similarly, if I had been a gain, there would have been a tax outflow. In this case, I will get a tax savings of 2250, which is 7,500 into 30%. Now, this is also my cash inflow. Correct? So my incremental cash outflow, or I can say net cash outflow, will become 50,000, which is outflow, minus 5,000, which is inflow, minus 2250, which is also a tax cash inflow. So 42,750 will become my overall cash outflow, students. Okay. Now, similarly, we have to work on the cash inflows, incremental cash inflows. So calculation of estimated savings per year that is going to happen. Increase in sales will be 10,000, which is very simple. Sorry, it was 1 lakh or 10 lakh. Just a second. It is 1 lakh actually. It's not 10 lakh, it's 1 lakh. Okay. So 1 lakh into 10% comes 10,000. Change in the operating cost is a saving of 5,000. So in totality, 15,000 will be a savings as the incremental cash inflow. Then let's talk about the depreciation. Depreciation also incremental amount will come for the next 5 years. So the depreciation on new machinery will be 50,000 minus 1,000, which is the estimated salvage value divided by 5. So 9,800 becomes the depreciation for per annum for next 5 years on the new machine. Minus, had we operated the old computer, the depreciation would have been 2,500. So the net increase in depreciation becomes 7,300, students. Correct? And now we got to know the incremental cash inflow and the incremental depreciation. Now we will come to the incremental tax impact. So the tax impact will be 10,000 plus 5,000 minus 7,300 into 30%. So this time 29,310 will become the outflow. Sorry, it is 2,310. So let me recompute it. 10,000 plus 5,000 minus 7,300. Sorry, 10,000 plus 5,000, 15,000 minus 7,300 into 0.3. So this becomes 2,310. Okay. So in this, cash inflow will become 10,000 plus 5,000 minus 2,310. Okay. So the net cash inflow will become 12,690. So while calculating the cash inflow, students, we have to ignore the depreciation, right? Because the use of depreciation is to only calculate the correct tax impact. And once the tax outflow we have, we can just simply take that value and adjust in the cash inflows. This is an important point, okay? Because a lot of mistakes happen here. Okay. Now, so 12,690 becomes the cash inflow. Now let's take the present value. So 12,690 will be there at the rate of 10% for 5 years. And the salvage value of 1,000 after 5 years will be there at the rate of 10%. So the total becomes 48,723. 48,723 minus 42,750 becomes 5,973, students. So the incremental NPV is 5,973, and hence it is better to replace the computer now because it is leading to the incremental NPV, students. So this was the concept of equivalent annual cost that we discussed, correct? Wherein there are two different projects having two different lifespans. So optimum replacement cycle can be calculated using equivalent annual cost, and it will be applied in the situation where we have differences. Yes, this is another good question, question number 12. So this also has a decision to be made when the taxi has to be replaced. X Limited is a taxi operator. Each taxi cost the company 4 lakh and has a useful life of 3 years. The taxi's operating cost for 3 years and salvage value at the end of the year is as follows. So let's say we keep a taxi for 3 years, okay? Then we will incur operating cost of 1,80,000 in year 1. Second year, we will incur 2,10,000, and third year, we will incur 2,38,000. And hence, there are different resale values. So in year 1, resale value is higher. Year 2, it is lower, and year 3, it is significantly lower. You're required to determine the optimal replacement period of taxi if the cost of capital is 10%, students. Simple. We will just make three different scenarios. First scenario, we will keep taxi for 1 year. Second scenario, we will keep taxi for 2 years. And third scenario, we will keep taxi for 3 years. Now, students, whenever question asks you to calculate the proper replacement period, then we will have to take into account all the different possibilities for running that taxi, or let's say for running that asset into the different life cycles. Okay. So the first life cycle is for 1 year. We will just simply calculate the cash outflow minus the operating cost plus the salvage value. This is negative. Second one, initial cash outflow, first year operating cost, second year operating cost, and second year replacement value, resale value, sorry. Okay. And don't forget to take a second year discount rate. Then third part, if the taxi is kept for 3 years, then 0th year cash outflow, first year operating cost, second year operating cost, third year operating cost, and the salvage value of the last year. So this gives us three different NPVs year wise. And now for 1 year, the NPV is 309. Second year, it is 547. Third year is 789. So without treating anything on the EAC, equivalent analyzed cost, what will one think? One will say that NPV is minimum here. So we should actually, sorry, the negative impact on account of NPV is minimum here because it's a negative NPV, right? So the out of these three, the best option is this one. Correct. However, we are ignoring the EAC part. Now, how will EAC work? As we have explained here, the EAC is the present value of cash outflow or cash inflow or NPV, whatever you want to say. Since we are talking about cost, hence we are saying present value of cash outflow divided by the present value annuity factor for those number of years. Okay. So it will give you EMI, let's say the EMI sort of a number, right? So 0.909, 1.735, and 2.486. These are the present value annuity factors. Okay. So for example, first year it is 1 divided by 1.1. Second year it will be 1 divided by 1.1 into 1 divided by 1.1 raised to the power 2. Correct? That's how the annuity factor is computed. So we have to divide this NPV by this. So NPV divided by PVAF. Now, these are the equated annual costs that can be compared. Basis this, the minimum cost is coming here, students. So, advisable to keep taxi for 2 years. So, the optimum replacement cycle will become 2 years, students. Okay. So there is one good question on independent and dependent. Let me just go there. Question number 14 is very simple. Student, again, I'm saying if you want me to cover any specific question, please do let me know. This one, question number 16. Very, very good question. Question 2, okay. Abrikesh is asking for question number 2. Okay, let's first cover question number 16, then I will go to question number 2, okay. The question number 16, students, following are the estimates of net cash flows and probability of a new project of Messrs. X Limited. So they have given us the three probabilities. First of all, I'm linking it to all the concepts now. Is this a certain situation? Or is this a risk situation? or is this the uncertain situation? I think this is a risk situation. Why? Because they have managed to estimate three different possibilities with three different probabilities. And what are those possibilities? Investments are same. Estimated net cash tax, estimated net after tax cash inflows per year is also given. And estimated salvage value after tax is also given. The required rate of the project is 10%. I think the first part is very, very simple. Expected NPV of the project. Expected NPV, how it will be calculated? If we have to just compute the probability multiplied cash flows and take a NPV of it. So 4 lakh in all the three probabilities, it is 4 lakh. So we have taken 4 lakh. Okay. Then for 1 to 4 years, the cash inflow, 30% chance of 1 lakh, 50% chance of 1,10,000 and 20% chance of 1,20,000 students. This gives us 1,09,000 for the recurring cash flows. And the present value factor at the rate of 10% for 1 to 4 years. This is again the annuity factor. So annuity factor is once you total the individual yearly factors, right? So this is 3.170 and hence this becomes the present value. For fifth year, 1,09,000 will happen, which is this value. And for salvage value, now we have taken the probability adjusted weights. 20,000 into 30%, 50,000, 50%, 60,000, 20%. So this becomes 1,52,000. And for the 5 years present value factor, we have taken 0.621 and hence 94,392. We take the total summation and reduce 4 lakh from it. We get an NPV of 39,922. Very easy and very simple, students. First part was very easy. The base case and the worst case NPVs. Now, can you tell, sorry, the best case and worst case NPVs. Now, with the given fact, students, can you tell me whether what will be the best case? Best case is the case wherein the cash flows, the cash inflows and the salvage value are highest. So whether it will be 1, 2 or 3, this will be 3, right? Because in the third case, the cash inflows is highest 1,20,000 and salvage value is also highest. The worst case similarly will be the case wherein the cash inflows are lowest. Correct? I am ignoring initial investment here because initial investment is same all across the three possibilities. Okay. Now, for these two NPVs, we can calculate. Yes. Now, in this case, 100% probability we will assume. Okay. So we will just take these values and calculate the NPV. Here also, we will take these values and calculate the NPV. Okay. So Abrikesh is saying in case 3 probability is 20.2. Yes, Abrikesh. That is okay. But still, the best case and worst case will not depend on the probability. It will actually depend on the cash flows. Okay. Although there is only a 20% probability, but still the cash flows are highest. Hence, that is called as the best case. Similarly, if we see 1,20,000, 60 and 4 lakh, this will become our NPV. And 1,20,000 and cash outflow minus 8,580 will become our NPV. Now comes the catch of this question. This is very, very important, students. The probability of occurrence of the worst case, if the cash flows are perfectly dependent over time and independent over time. They are asking about two different probabilities from our students. Of the worst case, that they're saying in case these are perfectly dependent over time. So what do we mean? In the decision tree, I said that the next, or let's say the last part is dependent on the second last part. The second last part is dependent on the third last part. Similarly, like this, it has to come from backwards, right? So what I will do in future will depend on my current thing. So that is called as dependent over time. Okay. Independent over time means anything can happen. So let's say in year one, we have the estimated net after tax cash inflows as the worst one, which is 1 lakh. So in the next year, which is year two, again it is open for 1 lakh, 1 lakh 10,000 or 1 lakh 20,000. Anything can happen. So that is called as independent over time. Correct? Because your year two cash flows are not dependent on year one cash flow. Correct? While independent over time, year two cash flows are dependent on year one cash flow. If in year one you get a worst case amounts, in year two also you will get the worst case amount. Similarly, in year three and four and year five, like that. However, in independent over time, anything can happen irrespective of what has happened in the previous year. Okay. Now this will form the basis of calculating the probability. They are asking us to calculate the probability of the worst case in case they are perfectly dependent over time. So for this to happen, year one has to be a year of worst case. So for year one, the probability becomes 30%. Now, since the year one has already happened as the worst case, the next year will have a 100% chance of being a worst case. That is what the overtime means. Oh, sorry, perfectly dependent overtime means. So for all the balance 4 years, they will have a 100% chance to have a worst case because they are all dependent on the first year. And hence the probability becomes 0.30. So 0.30 multiplied by 4 times of 100%, it will be 0.30 only. 0.3 into 1 into 1 into 1, like that you will do, right? Independent over time. Now first year 0.3 has happened. In the next year, again, there is a chance of 30. How much it was? 40 and 20. Sorry, 50 and 20. So in next year, again, there is a chance of 30, 50 and 20. So for next year, the worst case to happen, again, there is a chance of only 30%. In the third year, again, it will become independent of year one and year two, right? 30, 50 and 20, there are three possibilities. So from that, in third year, for worst case to happen, there is 0.3, 30%, and similarly for year four and year five. So this becomes multiplication becomes independent as 0.00243 students. Perfect. Prerna, your answer is correct. 0.3 is for the direct one. Abrikesh, we will do question number 2. Okay. After this. So easy and simple students, all logical. Then standard deviation and coefficient of variation, assuming that there are only 3 streams of cash flows, which are represented by each column of the table with the given probabilities. Okay, now they are saying you calculate with these 3 probabilities the standard deviation and coefficient of variation. So for calculating coefficient of variation, mean is already calculated, which is this expected NPV of the project in point number 1. We have to only calculate the standard deviation. Now, students, what is our mean? The first case, it is 39,922. No, wait, sorry. Actually, we can use both the values. There is a round off error that is only coming. That's all. 39,922 is also okay. And here also the value that is coming is 39,813. Because Herein, we are multiplying after doing the present value, and in above, we have first taken the probability and then we did the present value. Okay, that's the only difference, students. So let us follow this approach. Any approach is okay, again, I'm saying. So 8580 and 92060. Yeah. So best case and worst case we have already calculated. Let us calculate the 50% case here and then multiply it with the NPV. We get 39813, and using this we calculate the deviation, right? These are the deviations, taking a square and multiplying it with the respective probability, students, to arrive at the standard deviation. Okay, the coefficient of variation will become this much, 35,800, which is the standard deviation divided by the mean. Now the last part says that coefficient of variation of X Limited on its average project, which is in the range of 0.95 to 1. If the coefficient of variation of the project is found to be less risky than an average 100 basis points are deducted from the company's cost of capital. So now see, students, what logically they are saying is that generally the coefficient of variation ranges from 0.95 to 1. But if it is lower than 0.95, that means the project is less risky, because lower the coefficient of variation, the risk is less. In that case, they are saying we will reduce the 100 basis points. 100 basis points is what? 1%, correct? 100 basis point is equal to 1%. So 1% they will reduce it from the company's cost of capital. So instead of 10%, it should be 9%. Simple. So we have to recalculate using the 9%, students. See, actual coefficient of variation is 0.90 that we have computed in the fourth part. The range is this much, and hence we will reduce it from 10%. And ultimately, we will again calculate the expected net present value at the rate of 9%, students. Okay. So I think this was a very good question to understand. So fifth part was actually based on the concept of RADR, because risk adjusted discount rate says that if the project is less risky, we can reduce the discount rate, or let's say the risk premium. So this completes question number, I think, 16, right? Now let us come to question number 2. Yes. Perfect. I think this is related to the inflation. Yes. So question number 2, it says that XYZ Limited requires 8 lakhs for an unit. Useful life of the project is 4 years. Salvage value is nil. Depreciation charge is 2 lakh per annum. They have already given us depreciation charge. Expected revenue and cost, excluding depreciation, ignoring inflation. Okay. They have given us these estimates which are ignoring inflation. That means these are the real cash flows. Tax rate is 60%. Cost of capital is 10%, including inflation premium. So cost of capital they have given us including inflation premium. Real cash flows they have given which are excluding inflation. So first question, students, whether we can use real cash flows and nominal interest rate for calculating the NPV, the answer is no. For real cash flows, real interest rate. For nominal cash flows, nominal interest rate. Okay. Just like we studied that including risk in the cash flows, including risk in the discount rate. So similarly, including inflation in the cash flows, including inflation in the discount rate. So tax rate is 60%. Cost of capital we have studied. Calculate the NPV if the inflation rates for revenue and cost are as follows. So revenue and cost they've given us the inflation. Let's say revenue is growing by 10% in first year, second year 9%, like that. So students, can we convert the cost of capital from nominal rate to real rate? The answer is no, because we don't have a common inflation factor. Revenues are growing at different base, cost are going at different base. I mean, cost has a different inflation base. So better to add the inflation in the real cash flows to make them as nominal cash flow. Okay. So let's first calculate the nominal cash flows. 6 lakh, 7 lakh, 8 lakh, 8 lakh. Let's put them and multiply with the inflation factor. So first year it is 10%, second year it will be 9%. So for doing the second year inflation, first this 7 lakh will be multiplied with the first year inflation, then second year inflation, then arrived at the overall value of the second year. Then similarly for third year, this is first year, this is second year, and then this is the third year inflation rate. Similarly for fourth year, first, second, third, and I think the fourth one. Fourth one is also 7%. This will be 1.07. Okay. Similarly for costs as well, cost we will calculate. Now, we have got the nominal cash flows of revenue and cost. Now, what about depreciation, students? Depreciation, students, will remain constant because that is based on the historical cost. Correct? You already invested of 8 lakhs, so your depreciation will not change. So on that 8 lakhs, depreciation is 2 lakhs. On that 2 lakhs, you will save a tax of 60%, which is 1,20,000 will be your inflow. Okay. Now let's calculate the nominal cash flows, overall nominal cash flows. So for that, you will take revenue, the nominal revenue, nominal cost. This will become your net profit, which is the revenue minus cost. On that, you will adjust tax at the rate of 60% and arrive at the net profit after tax. Now you will calculate the present value of cash inflows. So you will first take the net profit after tax. You will also add in that the tax benefit on depreciation, which is 1,20,000 constant. So this is the catch here, students. While everything is nominal, only depreciation will be fixed. Because sometimes the question says that depreciation in the form of cash flow also needs to be increased. But here the question is silent, and hence we have taken the absolute amount as same. So cash inflow is this much, which is 129 plus 120. And hence multiplying with the present value factor, we arrive at the present values. So lastly, the NPV is this much, students. Okay. So I hope Abrikesh. Okay. Abrikesh, it is clear. You have messaged me. Perfect. Prerna is asking, sir, please explain the last part once again. Okay. Last part, I think in the previous question you would be asking. Question number 16. The last part, Prerna, it said that coefficient of variation. Okay. The fact here is they have given us a, so basically management has already taken a range 0.95 to 1. They are saying that their most of the average projects are coming into this range. Coefficient of variation. Correct. They are coming into this range, students. Now, if any project comes beyond this, beyond 1, then it will be having a higher risk. And if it comes below this, then it will be a lower risk. And students, from our knowledge of risk adjusted discount rate discussion, we know that anything with a lower risk will have to be treated with a lower discount rate. And anything with a higher risk has to be treated with a higher discount rate. Hence, they are saying if it is lower, then you reduce 100 basis points from your discount rate of 10%. So it becomes 9%. And hence we have recomputed the NPV using the discount rate of 9%, students. Okay. Uh, no worries. Prerna is now cleared. Okay, perfect. Okay, you're saying how 1,09,152 are taken from. Okay. So if you see 1,09,000 is actually a result of this bracket, which is simply, let me put here, 1 lakh multiplied by 0.30 plus 1,10,000 multiplied by 0.50 plus 1,20,000 multiplied by 0.20. Okay, this is how 1,09,000 has come. And now for the last year, it will be this plus salvage value also, right? So similarly for salvage value, 20,000 into 0.30 plus 50,000 into 0.50 plus 60,000 into 0.20. If you add this 1,90,000 plus the salvage value, we will arrive at 1,52,000. This is the last year cash inflow. Okay, clear now? Perfect. Let's move ahead, students. I think these are very much covered in the classes. Let me just see. See again, okay, let me just tell you the crux of this question number 22. In this also, there are different lifespans in which the company is contemplating to change or to replace, right? So as I said that for these type of questions, we have to calculate the decision for all the possibilities. That is changing at year one, sorry, replacing at year one, replacing at year two, replacing at year three, or replacing at year four, and even replacing it now. Okay. Abrikesh, we are taking the cash flow of 4 years, but in the fifth year, we are taking the salvage value plus cash inflow also. So for all the 5 years, we are taking. Prerna sir, this is question number 9, study material ones from test your knowledge section. Okay, let me see question number 9 from study material. Yes, so we have actually, okay, question number 9, right? I think this would be part of our,
Divan sir, this question is context of sensitivity analysis,
yes, sir, sure, sir.
and I think it may or may not be included in your assignment.
Got it. Got it.
So I do can you can do thing one thing, sir.
Sure.
You can link it to your our study material. Our
Sure.
it is available on a web.
Correct,
Or,
sir. Correct.
or I just send you the link. What I
No, sir. I have opened it. I have opened it in front of me. Only thing
okay,
is,
okay.
students, I might not be able to share this. I request all of you to open it at your end. Okay. And I will just quickly discuss this question.
Yeah.
So question number 9 from study material, it says that XYZ Limited is considering a below project in which they have given us the initial cost of the project They have given us other factors now. What are those other factors? Sales price per unit is given, cost per unit is given, and they have given us the sales volume in year one, year two, and year three. Discount rate is 10%. Now they're asking us to calculate the sensitivity of the project in relation to each of the following parameters. Correct? Which is sales price per unit, unit cost, sales volume, initial outlay, and project lifetime. And they're saying tax can be ignored. So to solve this, first of all, we have to, for any sensitivity question, students, first of all, we need to have the base case NPV, right? Because base case NPV is the NPV against which we will compare. Okay. Then only we can arrive at the different changes in the NPVs. So if I just see base case NPV, it is very clear. We will take the initial cash outflow of 10 lakh and we will multiply the unit sales into the selling price for the respective years, take a present value of it. We arrive at a base case NPV of 10 lakh, 3 lakh 10,000. This is very easy and very simple. Okay. Now, for doing the sensitivity, students, sometimes the question itself gives you that you have to change the factor by 10% plus or minus. But here, since the question is silent, so what we can do is we can actually make our NPV as 0. So we can arrive at what values should change in the input so that NPV becomes 0. So for that, let's say the selling price should be S, right? I mean, I'm just discussing the solution over here. So if you just compute the equation and put it in the that variable, you will be able to arrive at what will be the new selling price with which the NPV will become 0. So this is one approach. Okay. Or the second approach can be that you can also assume that if the sales price increases by 10%, then what will be the impact of NPV? That is also equally acceptable, even increase or decreased. Sales price, let's say it gets decreased. So then what will be the NPV? So similarly for unit cost as well as for the units, we can do that. Okay. I think the only confusion point to the students will be that since the question is silent, whether we have to change the input or we have to make the NPV as 0. Okay. Both the approaches are correct. We can adopt any of the approaches, students. Students, now quickly let us.
Because
Sorry.
here I would like to
Yes,
supplement
sir.
your discussion.
Yes, sir.
Now, students, please note that in the question is nothing has been mentioned about the approach you have to follow. So you can follow either of the any approach, alternative approach or the main approach. However, in the question, if it has been mentioned that you have to carry out sensitivity analysis by varying the percent by 10% or some percent may have been adversely affecting the variables, then you have to follow the second approach, that is alternative approach. Because in the air, the question requires that whatever be the change will in the NPV will take place consequent upon the a certain specified percentage adverse change. Okay, because like in selling, whenever we carry out a sensitivity analysis, it is very important to note that basically these changes are on adverse side. Like for selling price, we will take 10% decrease. Okay, for cost, we shall take 10% increase. And for initial outlay, we shall consider 10% increase. So we have to consider adverse cases. Okay, student, I hope it is clear to you now.
Yes, sir. Thank you, sir. Thank you, sir, for that. So now let us come to some of the MCQs. So students, these are new MCQs that we have not covered in the previous session. Okay. So hence I would want all of you to please respond to these so that we will at least come to know that whether the topic is clear to all of you or not. Okay. You can respond either on the question handle or on the Zoom application wherever it is possible. So the question number 1, it says that the projects bearing higher risky cash flows should be evaluated with discount rate. We have to fill in the blanks what it should be. If the projects is higher, I mean the risk is higher, then ideally what should be my discount rate? I will not reveal the answer. Abrikesh has responded. I request all others also to respond. Then we will reveal the answer. Lakshmi, Prashant, Kameshwari, Prerna, all of you have been there, and rest other people also. So we will wait another 30 seconds, students. I think Prerna has responded perfect. So the question number one, it is related to the risk adjusted discount rate, okay? And the answer is C, because higher risk will lead to higher than the risk-free rate discount rate being used. Correct? Then question number second, dash involves infinite calculations to obtain the possible outcomes and probabilities for any given observation. So student, what will be that? Whether it is simulation, sensitivity, scenario, or standard deviation? Abrikesh has responded. Yes, students. So yes, Abrikesh, you are correct. The answer is simulation, because in simulation, as we discussed, that there will be multiple rounds of infinite calculations. Let's say we assume 1 lakh there, and hence the answer. Perfect, students. I'm going to the third question now, students. Dash approach is used to compare the NPVs of multiple projects which have different operating life. This is very easy because this we just now discussed as a conceptual thing. So whether it should be simulation, coefficient of variation, equivalent analyzed cost, or sensitivity, what should be the right answer, students? Okay, Abrikesh has responded, Prerna has responded. I'm not getting any response from the other students. Okay, in the interest of time, I will move. It's the correct answer is equivalent annual cost. So both of you are correct, Abrikesh and Prerna. That is okay. Now let's come to the fourth question, students. Which of the following input in simulation analysis is held constant all over the simulation runs? This also we discussed today. There are some inputs that are held constant. So students, tell us what is the question number 4. Okay, I think Lakshmi has responded. I have got a response now, Lakshmi. For the first question, it is higher than the risk-free rate. That is correct, Lakshmi. Prerna has answered it. Okay, question number 4. Okay, this is interesting actually. Which of the following, students, please note each and every word in this question. Which of the following input in the simulation analysis is held constant all over the simulation runs? I think Lakshmi, I'm getting your responses now. You have answered question number 2 also correct. It's simulation. Yes, Prerna, Abrikesh. Question number 4. We are still yet to reveal the answer. Which of the following input in simulation analysis is held constant all over the simulation runs? Is it exogenous variable, parameters, random number, or probability distribution? So let me reveal the answer. I think it's parameters, because parameters are those set of inputs, cash outflow, that we have kept constant, right? In all the simulation runs, remember? Then lastly, question number 5. Nominal cash flows are cash flows which fill in the blanks for inflation. which includes, excludes, are neutral, or none of the above. This is also what we discussed today. Abrikesh has mentioned, okay. Abrikesh and Prerna have responded. Lakshmi, your question number three response came to me now. That is correct. So we discussed, students, nominal cash flow and real cash flows, right? Real cash flows are excluding inflation. Nominal cash flows are including inflation. These were very simple MCQs, students, just to see the entire concept building for today. Uh, Sir Ashish sir, now I think most of the discussion part is clear. We
Okay.
can open this.
Ashok ji, Ashok ji, now let give the access to the student for raising their queries.
Queries.
Okay. Ashok ji, also just give me the cost right for Ashish iPad so that I can.
So students, we request if there is any question that you want to ask, this is a golden opportunity to interact with Ashish sir and all of us. In case something is unresolved or something needs to be cleared, please do ask queries.
Uh, okay, Divas sir, I think I want to share one or two points with
Sure, sir.
students.
Sure, sir.
I think let me. Okay, so I think if there is no any queries, then I think I can share. Okay.
Sure, sir.
Students, okay, student. In today's class, we have discussed one of the very important topic, advanced capital budgeting decision. Now, student, here in today's class, one or two topic, very important topic has been covered. One topic is basically what I really that you will see when you will take the in the next forthcoming chapters. There is a concept called nominal rate. Okay. Now, sir has given the formula 1 plus real rate into 1 plus inflation rate minus 1. It is called your nominal. Divas sir, am I right?
Yes, sir. Yes, sir. Perfectly.
Is a nominal rate. Now, student, when we shall discuss the topic of foreign exchange exposure and risk management, this topic will also be useful there because there we shall see how we can compute because there is an interest rate parity or we can say interest rate parity theorem is there. There this topic will also come into the picture because a currency of a country is also affected, not only affected by the various factors, it is also affected by the inflation as well. Now, there is another topic I want to discuss with you. Now, though it is the topic advanced capital budgeting decision, you have seen we have covered one is risk analysis in the capital budgeting decision, or we can say incorporation of the risk in the capital budgeting decision. Then we have covered the replacement decision, or we can say not it is exactly the replacement decision, rather it is a kind of a replacement cycle. Because if we simply says a replacement decision, normally it is covered at a simple level of capital budgeting decision, whether we have to go for replacement or not. But here we can say it is a kind of a replacement cycle when we have to replace the asset, because of course there is a kind of a risk return trade-off. Devas sir, is there any other topic has been covered, or it is okay?
Yes, yes, sir.
Okay, both topics we have covered, na? Not ready. There is no other topic.
Yes, yes, sir.
Okay, but now there is one more thing I want like to student with discuss with you. When we were discussing the topic of financial management at your intermediate level, please remember there was one very important assumption that capital budgeting decision cannot be reversed. That no, you have this is a very basic assumption if you recall that. Now here there is one topic that is called real option. I think I say it is one of the arm of advanced capital budgeting as well. We can say here is it is also one of the arm of the advanced capital budgeting decision. But thing is that for this real option concept, you should have a basic knowledge of the option concept. So that's why we have covered this topic in the chapter on the derivative analysis and valuation. Because once you have got the concept of option, what is the final? Because here we have mentioned the option in context of financial instrument. Now, when we discuss the option, am I audible now? Okay. When we shall discuss the capital concept of option in context of capital busting, then this concept become the real option. So for real option, you have to have a basic knowledge of the option in case of financial instrument. So there is also another arm of the advanced capital busting decision, but problem is that at this very early stage it is we cannot give. But here in this real option, there are three options are covered. Growth option, okay, abandonment option, although there are other options, but in our syllabus normally we have covered only these three type of option. Okay, now let us see. When we were discussing the capital budgeting assumptions, we say it is cannot be reverse decision. But however, it is not so. Practically, what happens after say 1 or 2 years, if we found that our capital budgeting decision is not worthwhile to continue, so we normally abandon the our decision, because we say that suppose if I have started a capital budgeting decision, I have installed a plant, okay, it is going on well. After say 1 year, I found that my expected NPV, say after 1 year, because say the project life is at the beginning, I expected that the project life is 1 to 5 year. Okay. After say 1 year passed, from 2 to 5 year project life has been remained, and I realized that if I continue the project, okay, so I will have a loss of say 10 million. Okay. Now in that case, what option will be with me? I will say if I dispose of the plant today, say if I dispose of the plant today, I will get rupees 2 million as cash inflow. So I think there is no point in continuing this project anymore. So that's why it is also called the project. This is called abandonment option. This option is also available. So this part is also covered there, where we will discuss the topic. And there is another growth option. It is one of the very important decision. Now here, when we were discussing in our intermediate topic level, we were discussing if any project have a positive NPV, only then we should accept the same, or it is equal to zero, we should accept the same. But here, sometime even the project with negative NPV also are accepted, because sometime they will let us they will help us to create value creation for the other projects. For example, I just give you a very simple example. Like when the Chinese companies have started investing in the projects, in the Europe or the worldwide. So they were getting a negative value. They were getting NPV, but they were still providing the capital because they were sure that once they will get the monopoly, they will recover the return. And that happened because once they have come, they were working on a loss, but ultimately what they have done, they have shut down the other projection units. Now that when they have got the monopoly right, they have charged as per their own convenience. So sometimes this was also we can see that sometimes what we have discussed earlier, we are defining all the assumptions practically sometimes. Then and even for a drug manufacturing, drug pharmaceuticals, here the company invests a lot of in the research. Okay, and sometimes these are the sunk cost type of a thing. They never give it up. But say they are investing in a R&D of the five drugs. Only if one drug is successful, that will cover overall the cost of the these remaining four and even give up those profit. So all these are covered under this growth option. Then there is a timing option. Timing option generally implies that whether we can delay the project or not, whether we should delay the project. Sometime what happens, it particularly happens in case where the price of the product is volatile, like it is happen in the case of a gold mine. Because we have to invest mining, we have to invest a huge amount. Now once the gold is extracted, it will be sold in the market. Now gold prices of course are market driven forces, by the driven market forces. Now we have to see whether is it worthwhile to just we go into the production, or it is worthwhile that we should wait for the 1 year. Because for the next year we are of course we are making some assumptions. There are the probability that the price will. Okay, क्या कर दूं? Okay, okay, okay. Okay. Now, now here, it means we have a three options. Say we can make assumption that next year the gold rate likely to be 70,000. Its probability is zero point 0.2. Okay, its price is likely to 50,000 around. Its probability is 60.10. Now price is likely to be 65,000 around. So by it is probability is 0.70. So by this we can estimate a price. We can today say suppose this price is somewhere around 52,000 per gram per 10 gram. So we can take a decision whether we should go for mining or we should wait for the 1 year. So all these are real capital option capital budgeting decision. This is the advanced capital budgeting, but we shall discuss there. Okay, student. So if still you have any doubt, please you can free to discuss with the same. Okay, now next thing I want to cover. Uh, there is Divas sir has also touched upon the international capital budgeting. Little bit. Now this is another arm of the advanced capital budgeting decision. But for international, you must be thorough with the concept of the foreign exchange exposure and risk management, because here the foreign exchange will be involved. So that's why this topic has been covered. After once you well versed with the concept of foreign exchange, okay, and accordingly this chapter number is basically 11. First you get go through the chapter number 10, then you will. So here it is another arm of the capital budgeting. Now today, student, please note that today the world is globalized. Okay, their days are the gone when we are a village-like economy. But post 1993, after the globalization, or post 1995, even the foreign companies are investing in India, and we are also investing outside. Sorry, but problem is that once we cross the boundaries of our country, we are regulated by the regulations of other countries. Of course, for every countries, they have a favorable rules for their own citizen. Okay. For outsiders, suppose they have some regulations, strict regulations. So that's why there are some issues like are there parents, companies' cash flows, and subsidiary companies' cash flow. So we have to see when a subsidiary is there. We have a suppose India has established a subsidiary in say Vietnam. Now, of course, our company may be earning a huge amount of profit. but may not be allowed to bring this profit into our own countries, because suddenly there are some restriction. Like in India, if we talk about in India there are two things. One is full rupee convertibility, and there is partial rupee convertibility. Now, what does it full convertible means? Rupee convertible means whatever you are earning here, you can immediately convert it into full rupees, full dollars, or whatever the currency, and then you can remit it to the same. Partial means you are not allowed to remit all the amount. You have to keep it for some time. So all these restrictions can be there. Of course, when you were discussing the topic of the chapter number two, risk management, there was one concept is political risk. So these decisions are also affected by the political decisions, political risk. And when the risk is higher, of course, as sir has told you, risk is higher. So of course, our discounting rate will also be the higher. So that's why it is a link. All things are linked. Whatever concept you are discussing there, that will be applied in overall syllabus, somewhere, something else. So, okay, student, I hope it is another arm of the capital busting decision I have discussed with you. Now, there is one topic, Divas sir, I am just adding whatever you
Sure,
discussed.
sir. Sure, sir.
There is chapter chapter of, there is question number one in a study material. Okay, here basically what happened, we have covered the question, like assuming that I am the study material is before me. If student you can refer the study material, just or just read one line. Just I need your attention so that I can make you one very important concept. Here, in the first point, the company wants to know the expected NPV of this venture, independent probability distribution with 6% risk-free rate of interest. Okay, then it says possible standard possible deviation in the expected value. Now, student, here it question comes because here we have assumed the cash flows are basically independent, but sometimes it may be possible that cash flows are dependent. Okay, I think Devasar, you had touched upon one question where some dependent and independent question was there. Although that has not directly touched, but here I will show if we assume that our cash flows are dependent cash flows, then there will be difference in the standard deviation. Okay, now here the formula will be slightly changed. Okay, I'm just writing down the answer because if you are safe, I'm just saying if the cash flows are independent, the formula basically has been covered like this. Okay, student, please, if you have any doubt, you are free to discuss at any stage. Okay, please don't continue because if you ask the doubt, then it will be helpful for the other student as well. Okay, accordingly, and Devas sir, if you find any inconsistency, please do let me know.
No, no, sure, sir. Sure, sir. Sure, sir.
Now, if we see the solution, it has been said like that 85.4. Basically, that is the variance. Okay, of the first year. Okay, student. So the value comes 14.393696. Or you can say that 14.37. It hardly matters. If nothing has been mentioned, you can take up to the two decimal points. So don't worry about the decimal point out. Unless and until something has been mentioned, you can take them. Now I am saying, and I assume that is a dependent cash flow. The solution will be like that. Here we shall do, this will be the, if we take the square root of the same, it will become the standard deviation. So the formula will be simple formula. Okay. Accordingly, what I do, I start doing the same. I think it is a confusion is there between this. 8.619 divided by, okay, 7.237. So student, the value comes 14.793. So here it will be the standard deviation if the cash flows are dependent, and here it will be. Now you can see when the cash flows are dependent on each other, of course, the standard deviation is on higher side. So in the study material, there is one mention of Hillier model. Of course, I think this has been covered in question number maybe 12 or somewhere. Hillier model is mentioned is there. Exactly, there is not Hillier model has been covered directly in manner, but Hillier in one of the research paper, he has differentiated between this dependent and independent cash flow. From that onward, normally this is always used. So this was the overall correct of the today's session discussion. Now, Deval sir has discussed some MCQs with you. Of course, student, these with the permission of Deval sir, we will upload these MCQs in the our MCQ practice session that is available on the website. Now, student, whenever we come across on the topic of capital budgeting, two or three things one we have to take care. One or I'm just want to share. Now, here, sometime present value factor table may be given in the examination. So please remember that you have to follow these values, because normally these values may be given say up to 3 decimal point or 4 decimal point. So whatever they have given, you have to follow the same. Okay. Otherwise, if nothing has been mentioned, the best approach is you whenever you have to make the computation present value factor at their own, you can say up to 3 decimal point is a better version. Okay, that will give you a nearby value. And another important aspect in the capital budgeting is basically always remember we have to take cash flows. Sometimes it is a very common mistake, because in every book it has been mentioned cash flow, cash flow. Profit is always a, there are some hidden, you can say non-cash items in the profit that are adjusted. Okay. And very important, whenever we compute the cash flow, it is a very common mistake that I have noted among the students. They have a tendency to deduct interest expenses from the same. Please don't do it. Because please remember, student, whenever we make a capital budgeting decision, we use for discounting WAC, that is called weighted average cost of capital. And as you know that weighted average cost of capital is combination of our capital of the three sources, that is preference share, that is called KP, then debt, that is called KD, and that it is equity, that is called KE. Of course, there is some another source is retained earning, but generally these costs are considered same. So what happens when see there is no tax benefit on this, there is no tax benefit on this, but this is has a tax shield, which is called tax shield or tax benefit. So whenever we take back calculate, we take post-tax cost of debt. Okay, according to their percentage, we multiply their weightage, we multiply. So whenever when once we have computed, we have incorporated or when we have adjusted the tax benefit and our debt cost, if we again deduct interest from the cash flow, we are doing the giving the double taxation benefit. So it is very important that you should avoid this kind of a thing. So these are one or two tips. Any student has any doubt, they are free to discuss with me. So because in a board of studies, whatever doubt comes to my knowledge, or because normal student have a tendency, so they can ask me anyway. Let me check any query I have received, sir.
Sir, I think Abrakesh has raised the hand. Abrakesh Mankad.
Okay, okay. Let's see. Uh, Abrikesh, what is your doubt, beta?
Technical team, we can unmute Abrakesh.
Okay, Abrikesh,
Yeah.
please ask your doubt, beta.
Good morning, sir. My question in case of independent standard deviation calculation of independent cash flow and in earlier page that you have shown. Now in independent cash flow, you have mentioned that it's the square root of entire calculation. That means 85.4. And in dependent cash flow, it is individually calculated. So I mean, what is the reason? What is the logic behind this? Why? I mean.
See, there is such no logic. We cannot say there is any. See, it depends on the cash flow. Like in case if our second year cash flow is dependent on first year, so it is means dependent cash flows. If first year cash flow is not taken, then second year cash flow will not be taken. Yes. Okay. This is kind of this thing. So you see here there is a difference because here we are squaring because this factor plays a very important role. Okay, here this factor plays a very important role. Otherwise, everything is same. Only this double discounting factor is playing a very important role.
Yes, sir. Thank you.
Okay, thank you. Or any other student to we will wait for the 2 minutes. Then we shall one. 1 second. I think there is one. Otherwise, regarding standard deviation, we shall also cover the same topic again in a portfolio management. Okay, there will also the standard deviation will come again, but that time it will be covered in context of the securities portfolio that is, and Devas sir will take the session again.
Yes, sir.
So here they will, so the actually standard deviation is mean a deviation from the expected values. It is a very simple logic. It is a very basically statistic mean only. So here we are seeing whatever we have discussed in our earlier classes, 11th class. Now it is using the practical, not very, and even it is used sometimes practically as well. And there was one question student was asking about the sensitivity analysis regarding which approach we have to follow. I think I don't remember whether I mentioned. I think there is question number study material. I think this is a question number 12 in study material where only one approach will be used. Okay, here the structure of the question is that we cannot assume it will vary from 10%, etc. So that will be used there. Okay, student. Now we are nearing to closing our session. Now, before going, I'm just sharing with you my own contact number. You can contact us through the mobile app, or you can send your queries. What I'm sharing with you, you can contact me directly at this telephone number. Instead of writing a mail, even you can contact me over this number. This is my STD code. This is STD code of Noida, and this is a number I will pick up, or my colleague CA Manish Gupta will take care of it. Okay. Now, student, you can send the mobile, or you can also send me the queries at sfm-final@ICAI.in. Okay, student. With this, we come to the end of the session of today's session, and I hope this session must have helped you. And of course, November exam will be there. Before that, we will have other sessions like mock test, etc. Even viewers for the section. Please do attend them. And if you have any query, even between, if you have any query relating to this topic, you can send us. We will directly connect it with you, Divas sir. Okay, in the next class.
Sure, sir.
Okay, Divas sir. Thanks a lot.
Thanks a lot, sir. Thanks a lot, sir, for sharing your valuable insights on the topic. Thanks a lot, sir.
Okay. And one student says, sir, please share today and previous session notes unable to download. Okay, assignments as well as note will be get uploaded. Okay, Divas sir, share some notes among the student. Okay,
Sure.
but and we will get it circulated among the students.
Sure, sir.
Okay. Okay, student. Thanks sir for patience listening, and have a nice day. Thanks a lot.
Thank you, sir. Thank you. Thank you, man.
Session over. Okay.